All right, before we jump in, just the usual but super important heads up. This is all for educational purposes. It is absolutely not financial advice. Investing is risky, so you've always got to do your own research. Okay, let's get right into it. For a while now, the PLAZM protocol has been chugging along on two really solid engines, but a third one, a brand new one, just came online. And honestly, it seems like it changes the entire game for the long run. So today, we're going to break down exactly how this new engine works, what the numbers are, and why it's such a big deal. You know, for pretty much any project in DeFi, this is the million-dollar question, right? It's kind of the holy grail. Growth almost always means you need new people, new money coming in the door. But what if you didn't? What if a treasury could just grow itself, using only the cash it's already making? Well, it looks like we might just have an answer to that question. The third engine is called Bide and Grow, and it is officially live. The treasury has started using its own profits to get bigger. And this is the number that you're going to hear a lot about. 4.2. That's how many new, income-generating bonds the Treasury is now buying for itself. Every single day. And get this, it's not from new deposits. It's coming from taking 20% of the daily yield, which right now is about $167, and just plowing it right back into buying more infrastructure. It's wild. So how did they pull this off? Where did the money for this new engine even come from? Well, it all came down to a really smart shuffle of the daily yield. Let's look at the before and after. Okay, so here's how things used to work. Super simple, really. About 65% of the yield went to buy and burn. That's what puts the squeeze on the token supply, making it deflationary. And then around 28% went to buy and build, which is all about making the protocol's trading pools deeper. A solid two-engine machine. No, check this out. This is the big change. Buy and burn is still there, totally untouched. That defense is just too important. But they dialed back the buy and build function a bit, and that freed up a clean 20% of the daily yield to fire up this brand new buy and grow engine. So you might be wondering, wait, isn't it risky to build less liquidity? That's a fair question, but the answer is this really cool concept called active liquidity. Think about it. With over $800 of automatic buys from buy and burn hitting the market every day, that buying pressure itself acts like a wall, soaking up sell orders before they can really even make a dent. And this quote from the founder really just sums up the whole strategy. The protocol's already got a solid 100 grand in its liquidity base, and you add this daily active liquidity on top, well, that gives them the room to redirect some of that firepower towards compounding growth for the long haul. Okay, so let's get into the nitty-gritty, let's crunch the numbers and see how this actually works. Because that 4.2 number isn't some guess. It's happening right now based on live data. It's actually pretty simple. You start with the total yield for the day, which is currently about $837. The buy and grow engine gets its 20% cut, which comes out to $167 and change. Then you just divide that by the current bond price of about $39.80, and boom. There it is, 4.2 new bonds bought by the Treasury for the Treasury every single day. Now, I know, 4.2 might not sound world-changing, but this is where consistency becomes a superpower. Zoom out a little. That's almost 30 new bonds every single week, over 120 every month. And if you look at it annually, we are talking about more than 1,500 new bonds added to the Treasury without a single new user deposit. And here's where it gets really mind-bending. It's not just compounding. The compounding compounds. Those 1,500 new bonds from this year, well, they're going to start generating their own yield next year. That means more daily cash, which means more money for buy and grow, which means, you guessed it, even more bonds bought per day. It's a flywheel that actually speeds itself up over time. So why launch this now? Of all times, in the middle of this brutal bear market? That's no accident. In fact, that's the most strategic part of this whole plan. The timing gives them a massive, massive advantage. I mean, just look at this. It's kind of crazy. At the peak of the bull market, one of these bonds would have cost you about $250. Today, it's under 40. That is an 84% discount. The protocol is basically dollar cost averaging into itself at a fire sale. This chart really tells the whole story. That same $167 daily budget would have barely bought 2/3 of a bond back at the all-time high. Today, it buys 4.2 of them. Every single dollar being compounded right now is getting over 6 times more infrastructure than it would have at peak prices. They're building the foundation for the next cycle at a huge discount. So what does all of this actually lead to? What's the big takeaway?
Well, it's a genuine paradigm shift. It completely changes how you think about a treasury surviving and even thriving. And this is the punchline. This is the whole thing. Before today, for the treasury to grow, it needed new users, plain and simple. Now, the number of new users required for the treasury to expand is zero. Its growth is completely detached from market hype or getting new people in the door. Let's really hammer this home by looking at a worst-case scenario. Before, if the market went dead quiet, no new users, the treasury would just be flat. It would be playing defense but not growing. But now, in that exact same gloomy scenario, the treasury still grows by 4.2 bonds a day. It plays defense and offense at the same time.
And this creates what the founder once called a unicorn loop in DeFi. It's beautiful, really. More bonds mean more yield. More yield means more fuel for the buy and burn. More buy and burn means a stronger price floor for everyone. It is a self-sustaining, self-reinforcing cycle of growth and defense that just runs. So if this engine just keeps running on its own, where does it all go? What's the ultimate endgame for a compounding machine like this? So here's a pretty conservative projection, right? Assuming prices and yields just stay where they are, you can see how it picks up steam. Year 1 adds over 1,500 bonds. By year 3, it's adding almost 2,000 a year. And after just 3 years, the treasury would have grown by nearly 50% just from its own compounding. And the ultimate goal, the final boss, if you will, is what's known as the tipping point. This is the moment when the treasury gets so big and its daily yield is so huge that the automated buying from buy and burn literally becomes bigger than any selling pressure on the market. It's the point where the price floor just becomes permanent. 4.2. That's the number. 4.2 new bonds every day from yield alone. $167.49. 20% of what the treasury earns every single day redirected into building more infrastructure. Not from your wallet, not from new users, from trading fees earned by 11,132 bonds doing what they do, providing liquidity across DeFi. Those 4.2 bonds will earn trading fees tomorrow, and the day after, and every day for as long as DeFi exists. And those fees will buy 4.3 bonds, then 4.4, then 4.5. The compounding compounds. The engine grows itself. 126 bonds a month, 1,500 a year, at prices 84% below the peak. Every bond a permanent addition to the yield engine. Every bond more fuel for the buy and burn. Every bond one step closer to the tipping point where buying permanently exceeds selling. That's buy and grow. That's the third engine. And as of day 158, it's running. Thanks so much for tuning in. And one last time, remember, this is all educational. It's not financial advice. Every investment in DeFi, including PLAZM, has significant risks. Never put in more than you can afford to lose, and please always do your own deep research.